Okay, welcome. It is Monday, July 20th. This is the Anderson Report. I apologize for not doing a weekend update over the weekend. We had a couple of structural issues in the studio. We've gotten those pretty much straightened out now, at least to the point where we can do a broadcast a little bit later than what I normally do it. This is 9 o'clock. I've usually been doing 7 o'clock, but I wanted to get this in tonight. And I scheduled it after I was confident that the studio would be presentable, and the bookcase area behind me would be put back together after a little issue we had over the weekend. Okay, so let's talk about today's market real quick because there were a few significant things today. Uh, as a week ago, the NASDAQ had hit an intraday high of 10,820. It then backed off from that level, closed down 2% that day, struggled most of the week, underperformed on the week. I believe it was down 1 or 2% on the week. We're going to get into last week in a little bit. Um, and I'm sure that people were a little bit hesitant about what does this mean? How much of a correction are we going to have in the big momentum tech names? And today they got some pretty strong sponsorship from some upgrades in the sector from some key names on from some analysts and some people that are very well known in the tech sector. Big cap tech, i.e., the internet traffic trade, significantly outperformed today to the point where Nasdaq was up 2.1%, closed at an all-time high of 10,727, but did not quite get to what its intraday high was a week ago today of 10,820. I usually don't use intraday numbers as an important marker for the stock market averages just because a lot of things happen that skew those intraday numbers on occasion. Only when it marks a significant turnaround in the market do I think that they are really significant, which is why I mentioned that 10,800 number. But that notwithstanding, the NASDAQ today closed at an all time high for the first time in over a week, and significantly outperformed the Dow, which was pretty much flat on the day. The S&P 500 also had a great day today, closing at 3246. It got above that 3233 level, which had been the high close from uh, early June, just following the May employment report. So the S&P 500 is now positive year to date, and it's maybe 4% from its all-time high of 3386, which it hit on February 19th before the big coronavirus sell-off started. So NASDAQ, an all-time high today. I don't think too many people were expecting it coming in today. Frankly, I was expecting a little bit of profit taking in the market overall, given all the news that we had over the weekend about big outbreaks in the virus in heavily populated areas, South Florida, parts of Texas, Houston, San Antonio, Austin, major population areas, all well over a million plus. Houston, being the third or fourth largest city in the country, and in as well as in the Phoenix area, in Arizona, and parts of California. I just thought that the headlines were tilted a little negative coming in today very pleased to see the market hang in there. Although I will say one word of caution on today's action. The advanced declines were negative by 4 to 3, meaning there were 4 decliners for every 3 advancers. On NASDAQ, the composite advanced decline not nearly as strong as the NASDAQ composite. NASDAQ composite, clearly a capitalization weighted index. The advanced decline of all the NASDAQ stocks were positive by maybe 200 issues. So, still a very strong day today. Consumer discretionary plus 2.7%. Info technology, that's your internet traffic trade. That's the big momentum names driving NASDAQ up 2%. We'll just have to see if this continues into the remainder of the week. We had one significant earnings report today. IBM reported after the close. It was a mild beat. I believe the stock was up after that. Although I did not listen to the conference call, and I don't know how the stock acted following the conference call. Clearly, IBM is not the market dominant stock that it was for a few decades, but it's still IBM. It's still going to get attention when they report their earnings and what they have to say about their exposure to the virus going forward. But I would just think it's a positive sign to have them beat consensus. It's going to be a very heavy earnings week, the remainder of the week. Although the economic calendar is a little bit light, was pretty much quiet today, quiet tomorrow. We'll get some housing indicators on Wednesday, and then, of course, the weekly first-time jobless claims on Thursday. So let's take a look at last week, since I didn't quite get a broadcast in recapping last week. And I had some very positive responses to our weekly review that I did a little over a week ago. So basically what we had last week was a day in which, as I mentioned earlier, NASDAQ had a little bit of an in a very short-term intermediate top, traded 10,800 intraday on Monday, went from up 2% to down 2% that day, underperformed the S&P and the Dow Jones the remainder of the week, but that's okay. It had been a major outperformer for the last 6 weeks and really probably the last couple of years. And as we saw today, no real permanent damage to the NASDAQ index, obviously making a new high. So last week, let's take a look. The Dow Jones finished the week plus 2.3%, plus 3.3% month to date. Those numbers are still good right now because the Dow is basically unch today. For the year, the Dow is down 6.5%, and it's just less than 10% below its all-time high from February 12th. The S&P 500 was up 1.2% on the week, and it backed that up today by rallying 0.7%. As I mentioned earlier, the S&P closed above its June highs today, a very positive sign for the S&P. And we had a very positive chart pattern play out as a good predictor from about 10 days ago when the 50-day moving average moved above the 200-day moving average on the S&P 500. They call that a golden cross. Sometimes it's a contraindicator. So far in this case, it has not been. The S&P has followed its momentum higher. And I should add, with last week, the Dow closing just below 26,700, above its 200-day moving average. All the major market averages now, for the first time since June, and it didn't really hold in early June, are above their 200-day moving average. With the S&P's action today, the S&P came into today up 4% month to date, and came into today down 0.2%. So now the S&P is up about 0.5% year to date, and down just less than 4% from its all-time high of 3386. So NASDAQ last week lost 1.1%. It had that big turnaround day on Monday. Clearly, it just blew right through that today. And with the aid of some strong sponsorship from some widely followed analysts and market strategists, saying that they still expect the big momentum NASDAQ names that have been pushing the internet traffic trade to outperform for the remainder of the year. The NASDAQ came into today up 4.4% month to date. So now it's probably up more than 6% month to date, and up 17% year to date. Those are just huge numbers. And obviously, with the NASDAQ making multiple new highs, getting through the 10,000 level for the first time in June, failing, getting through it again about a week and a half later, failing, and then this last time it went through, not looking back, 10,700. There's a 7% cushion on the 10,000 level for NASDAQ, which is, just very encouraging. And we saw last week that even though it corrected a little bit and underperformed for a few days, it's still in a very powerful uptrend. Now, we also want to mention, and we mentioned it on Thursday, the Russell 2000 had a phenomenal week last week. It has trailed miserably. It's the small cap sector of the market. And it was up 3.5% on the week. Ironically, it was also up 3.5% on its strongest day last week, which I believe was Wednesday, although call me out on that if I got it wrong. So the Russell's up 2.2% on the week. Last week, it is still down. To give you an idea how much it has underperformed the higher capitalization market averages, it's still down 11.5% year to date, and down over 13% from its high water mark of the year, which was actually in January of just above 1,700. Now, the positive is that closing the week at 1473, the Russell got above its 200-day moving average, I believe for the first time since the big sell-off when the market really came apart in late February and early March, when the coronavirus started to when it started to be very aware that the coronavirus was going to be a big issue. So NASDAQ today only down 0.3%. I would say that after last week's performance, we'll take that in a heartbeat. The Russell 2000. The Russell 2000 went out at 1469, holding its 200-day moving average. It would be very positive to see the Russell continue to hold its 200-day moving average, along with the three larger cap averages: the Dow, the NASDAQ, and the S&P 500. So just to give you an example of how really well the small cap sector of the market did, I mentioned the Russell. It was up 3.5% last week. The S&P 400 mid cap was also up 3.6%. The S&P small cap 600, which is probably the closest parallel to the Russell, was up 3.7%. What does that tell us? That tells us that even though there was some money that, at least for the week, rotated out of big momentum tech names, it did not leave the market and go into just totally defensive mode. It went into smaller cap stocks, which have significantly underperformed the rest of the market. And some investors clearly feel that the small cap sectors of the market have a very good shot at outperforming during the second half of the year. And obviously, all these people are in a performance business. They're looking at what that's also telling us is, even though we've had big outbreaks of the virus over the last 2 to 3 weeks, maybe a little bit longer, it's kind of is telling me that the smart money in the market does not feel that we're going in to broad-based shutdown mode. Certainly nationally, we're not going to have the airlines shut down. We're not going to have the hotels shut down. We may have a slower reopening of indoor activities, as we've seen in some major metropolitan areas with dining restricted to outdoor only. But the big money is saying that they feel that even though there's maybe a couple of hiccups on getting everything in the economy reopened and getting these indoor activities past their capacity constrictions of 25%, 50%, 75%, different percentage restrictions for different geographical areas, the big money thinks that we're still going to go forward. We're going to have a very strong economy in the second half of the year. If they thought the economy had major issues, you wouldn't see the small cap sectors of the market act as well as they did last week. And just because I mentioned the airlines very briefly, there was one very critical announcement by American Airlines late last week where they said that they are going to start booking their airlines to capacity. They're not going to hold back on the middle seat. They're still going to disinfect very rigorously after in between every flight. They're still going to have people wear masks on board. I'm not sure if they're doing temperature checks or not. But for American Airlines to say that they're going to a full capacity schedule going forward, it's almost laying down the gauntlet a little bit for the other airlines. It'll be fascinating to see if some of these other airlines match what American has said, or still really operate in a much more cautious mode where they're not going to be selling the middle seat. I think I saw the Delta CEO on either one of the Friday night shows or some other comments over the weekend saying that as of right now, they are not going to be selling middle seats. So if you're going to fly somewhere and you want to make sure that the middle seats are going to be empty, you might fly Delta. Okay, so let's look at some other metrics from last week. The best sector of the 11 sectors of the S&P 500 was the industrials, up 6%. Notice that the Dow Jones Industrials outperformed the S&P and NASDAQ last week. Also, the materials were up 5.5%. That's basically paper, forest products, chemicals, probably some metal and mining. Basically, anything that goes into making other stuff is what falls into the materials sector of the S&P 500. That is clearly a cyclical part of the market and a cyclical part of the economy. It'll be interesting to see if if that's a 1 week move, or if the industrials and the materials act as well this week, or at least hold those gains as they did last week. That would also tell me that big dough investors feel that despite a few fits and starts, the economy is going to be strong in the third quarter and even stronger in the fourth quarter. Okay, healthcare up 5%. Clearly, a lot of hospitals are going back toward normalized operations where they had been declining all routine procedures, elective surgeries, et cetera, et cetera, et cetera. That's why and actually a lot of big hospitals had laid people off that were not in the emergency room areas or in the infectious disease areas that were treating people for COVID, and I'm sure that they've been calling people back. I don't recall exactly how many job ads last week were from the healthcare field, but I would think that you would see those numbers continue to improve for healthcare over the next few weeks. Now, electric utilities up 4%. Some of that might have been a little bit defensive, but also keep in mind that utilities are economically sensitive. Okay, if businesses are not shut down and are running, they're running a lot more air conditioning, they're running a lot more electric power than if they were shut down. So, utilities up 4.2%. I think it's a little bit of a mix of maybe a little bit of defensive money. Bond yields went down last week. Investors, if they're in the cautious mode, they're still looking for yield, and there's a lot better yield in a lot of utility stocks than there are in a lot of certainly in the government bonds and even in some of the corporate bonds. So the utilities, I think, is an area to watch because in addition to being defensive, there's an economically sensitive component to them. And I think that kicked in last week as well. I mentioned the small cap sectors. On the look, the underperforming sectors were not really down that much, but they were down a little bit. Telecom services down 1%. That was the profit taking in your big NASDAQ momentum names. Information technology down 1.2%. That's exactly the same thing. That's that internet traffic trade. And last week, consumer discretionary down 1.6%. Could have been a little bit fear that maybe we're going to have to shut down some areas around the country, and that maybe people aren't going back to work as quickly as anticipated or as hoped. But with consumer discretionary down 1.6% all of last week, it did a very sharp reversal to the upside today. The consumer discretionary portion sector of the S&P 500 up 2.7%. That's a very positive sign to me. Infotech up 2%. That's your internet traffic trade with the NASDAQ momentum names. Energy was off a touch. I still see oil holding $40. It's a level to watch. We're not going to like for the mid 40s or the upper 40s right away, but let's just see if oil can hold that $40 level, and then we'll see where we are a few weeks down the road in terms of it trying to make a little bit of a move higher. Well, I'm looking at a couple of questions in the chat here. What do you think of Twitter earnings out on Thursday? Look, I think Twitter has just got, first of all, it's very, very difficult for me to comment on individual stocks. I would certainly pay attention not only to Twitter earnings, but to what they say, obviously, about this incident they had late last week where there was a breach in their security system and some very very high profile blue checkmark people had fake tweets go out on their behalf about connected to some type of a Bitcoin scandal. So I think that Twitter is gonna get a tremendous amount. 90% of the questions that they get in their conference call after their earnings is gonna be on this breach that they had from late last week, and pretty much everything. I don't know that really anything else matters. I don't see. I think the biggest hurdle for the stock price is going to be instilling confidence among shareholders that they can get this under control. I doubt very few people feel they have it under control right now. Don't all indices move in the right direction? Not necessarily. That's why we go over them and talk about them so much. Um, Look, the Dow Jones is a arithmetic index of 30 uh, blue chip stocks that have been embedded in the traditional part of the American economy for a few decades. They do make changes on occasion. They added Apple, they added Intel and Microsoft in the 90s. Uh, they take stocks out that are serial underperformers that they feel no longer. They took GE out 2.5 years ago. It had to be a monumental decision for them to take GE out. If it was not one of the original Dow components, it had been in for a very, very, very long time. Um, but it's an arithmetic index, and a 10-point move in Apple or IBM makes as big of an impact, even though it's a high price stock, as a 10-point move would for Procter and Gamble, which you're probably never going to see because Procter and Gamble is a little bit more of a defensive issue, pretty much a consumer staples company. Um, and you're not going to see a 10-point move from many other Dow components either. I just mentioned it with Apple, and uh, because it's a $300 stock. You will get those big price moves from Boeing on occasion. And basically, um, every point that any stock in the Dow moves is a little bit less than a 7-point move for the entire average. It is not a capitalization weighted index like the S&P is and like the NASDAQ is. NASDAQ is very heavily technology laden, which is, if you will notice that in mid to late February 19th, the S&P and the Nasdaq made an all-time high. The S&P's all-time high was 3386. That is still its all-time high. The Nasdaq's all-time high at that point was 9817. The Nasdaq is way through that point. In fact, at the end of last week, the Nasdaq was 7% above what had been its all-time high in February. The S&P 500 was still 4.8% below what is still its current all-time high. They both made all-time highs on the same day, February 19th. NASDAQ has been driven by the big momentum tech names. You know what they are: Apple, Google, Microsoft, Facebook, Amazon, Tesla, even though I don't know exactly where it stands, but everybody's talking about it. And one or two other things. We need to pull back on gold and silver. Yeah, look, I'm going to do something on gold, if not before the end of the week, maybe the following week. Gold has been acting very well. Silver has gotten through 19 and is maybe threatening the $20 level. The high for gold over the last decade was in 2011 when you had the Greek debt, not quite default, but sort of bailout by the EU. You had major debt concerns in the rest of Southern Europe. That's before Mario Draghi gave his infamous whatever it takes to save the euro speech. Then the EU started doing massive amounts of QE. Um, we had in the fall of 2011 a major uh, uh, budget impasse that caused one of the rating agencies to, for a maybe 6 months or so, lower a debt rating from AAA to either AA or AA plus. Gold, which had already been rallying, rocketed up another leg after that, got up to about 1960, didn't quite hit 2000. Right now, gold is just a little bit above 1800. Silver is at between $19.50 and $20. Silver, I believe, traded very close to $40 back then. So, look, I don't know really what's going to cause what would cause maybe if the market got really hot, um, maybe gold will pull back a touch. But I do think that the money is uh, um, going into gold just as a potential hedge against. Really, I think gold is not the ultimate safety trade that it used to be. It's more like a hedge against uh, total chaos among the central banking system, which we're not really on the verge of. But there are people that are concerned about the levels of debt that the U.S. is now carrying, and a couple of countries in the and basically the EU. Um, Comment on potential flooding in China. I've seen some headlines about the potential for that. I have not seen how much damage is potentially done. Although the Shanghai Composite, and I didn't catch what it did um, in Monday session, but the Shanghai Composite was down 5% last week. Now, with that being said, the Shanghai Composite had rallied 17% over 8 days at the beginning of July. No secret that that was also the beginning of the third quarter and the second half of the year. The Chinese had encouraged people to buy the market almost as a patriotic move, going back to the very beginning of July. And frankly, when the market got so hot and rallied so strong, they actually put out a statement telling people to curb their enthusiasm a little bit. I think maybe they learned some lessons from 2015 when the market got overheated. Um, Mini bubble bursting activity 5 years ago, and took a long time for the Chinese market to recover. Some sectors have it, probably still haven't totally, but the Chinese market is definitely worth keeping an eye on. Particularly with talk that they had gotten a lot of their industrial activity back online. Not this past week, but the week before. Copper was up over 5%. Probably a lot of buying from China. So we'll have to watch that potential for that flooding in China and see if it really does have a major impact, John. I am not as up on it as I wish I was right now, but I'm going to look into it pretty heavily. Okay, so that's pretty much all I have right now. Yeah, I see what you're saying, that flood, they're talking about that Three Gorges Dam in China, and it could be a big problem. I don't know what the latest update is on that. It's definitely something to watch. Um, Look, we had almost no economic data today. We have very little economic data tomorrow. I actually like that because it means the market can kind of trade on its own accord. Unfortunately, it kind of gives the economists and the wannabe economists and the people that think they're economists, gives them very little to talk about. for myself, being a little bit of a market strategist, market psychologist, it's very interesting to see the market trade on its own when you don't have key pieces of economic data coming out, potentially influencing it for a couple of days. So it'll be interesting to see tomorrow if we still have momentum from NASDAQ, and if the S&P can hold this move above the June highs. So that's pretty much it for me. Please subscribe to the channel if you haven't already done so. It's The Anderson Report on YouTube. On Periscope, it's TJ Anderson 12. My Periscope handle is TJ Anderson 1. If you subscribe to the YouTube channel and you want notifications on when the next broadcast is going to be, I've been trying to put that out at least 2 to 3 hours in advance. Hit that little bell that's next to the subscribe banner, and you will get some type of an update on when the next broadcast will be. Everyone have a safe evening and a nice Tuesday. And we will talk to you most likely sometime tomorrow. Have a great night, everyone.